Here to continue the conversation on the labor market and the state of the U.S. economy is Andrew Patterson, Vanguard Senior International Economist. And thank you for joining us here today. Just want to get your 30,000, feet view of this report. What are your big takeaways?
Sure. So not a whole lot of surprises in today's report. I realize it was a bit above consensus. But if you break it down on an industry basis, you're still seeing some gaps in terms of pre-crisis levels of employment in the service sector, particularly in leisure and hospitality. Those are closing but slowly. Manufacturing jobs, they're actually back above pre-COVID levels. You were talking before about labor force participation.
Right.
I think that's a very good metric to continue to keep an eye on. That was one of our non-consensus calls going back to late last year, where we did not believe that labor force participation, due to demographics, due partially to early retirements as a result of the pandemic, we didn't believe that was going to get back to pre-pandemic levels of around 63.5. We thought it was likely to hover closer to 62.5, which seems to be where it's been for the last couple months. And then in terms of going forward, you mentioned before the weekly claims data. That's something that we're putting a lot of focus on as well. Those are hovering around 250,000 now. As Fed policy impacts start to make their way through the economy, which usually takes around, call it 6 to 9 months, if those start trending up towards 400,000, that's when we would start to really think about, even revising further down our expectations for growth.
Well, I always appreciate when we have an out of consensus view that we can kind of pick apart here. So thanks for explaining that. Want to get your take on the Fed now. It seems like 75 basis points for the next meeting in a few weeks, pretty much baked in. We are going to get a big CPI print next Thursday. Any chance that we get to 100 basis points?
I don't know that they would use 100 unless for some reason they had to come at this with shock and awe tactics, which I think they'd like to avoid. 75 pretty much priced in for the next meeting, possibly for September as well. Beyond September, that's when things get a little, I don't want to say dicey, but that's when we start to realize the implications that policy is really starting to have, because at that point, you're likely above most estimates of the neutral rate, which is somewhere around 2.5%. So the policy rate is pushed above that. And again, I mentioned before, policy impacting fundamentals with the lag. You should start to get an understanding of the trends in fundamental data, whether it's inflation, labor market, output, what type of impact these changes in Fed policy over the past several months are really having on the economy.
Well, and then we got to talk about the dreaded R word, recession. We've seen the yield curve flattening. In fact, the short-term rates are screaming higher. The 2 years up materially today. And also the 13-week T-bill rate, which tracks the federal funds rate, that has been higher. I think it's at basically the same levels that we came into the pandemic with, nearly. I'm just wondering, at what point do we get an inversion at the very short end of the curve, and what does that portend for the recession possibilities in the future?
Yeah, and that's key. You mentioned at the very short end of the curve. As an economist, we do get concerned when you see things like 2s, 10s invert, which did happen briefly this past week. But what we're really focused on is that 3-month, 10-year spread. When that inverts, that is a clear signal. Nothing's a perfect crystal ball, but that's about as clear of a crystal ball as we can get. A clear signal that recession is likely over the next 9 to 12 months. If you want to put probabilities on it, we believe in terms of an outright recession. We'll pay attention to the growth numbers this quarter. Those could be a little bit wonky still, given volatility in inventories, global trade. But going forward, an outright recession over the next 12-ish months, maybe it's a little elevated relative to history, but you start going beyond into the middle of next year, and we're talking about recession over 50% probability.
Wow. I'll give you the floor here. We got time for one more. What other economic reports, indicators are on your radar that we have coming up here?
So I'd say it's inflation reports, whether it's CPI, whether it's PCE, right? The Fed has dropped a lot of the language they typically use to try to differentiate between whether it's core or headline, whether it's their preferred measure of PCE versus CPI. They're just outright acknowledging that inflation is high. Keeping an eye on wage growth, so the jobs report, and also keep an eye on the weekly claims data that comes out next week and subsequent weeks as well.
All right, got to leave it there, but appreciate your thoughts on this. Lots of insight. Andrew Patterson, Vanguard Senior International Economist. Thanks for joining us.